Hello, and welcome to the Master Trader Program for 2020 online event. This is Bob Weissman. We are doing a question and answer session today that is a replay from yesterday's event. Mark actually took some extra time. This will be about 2 hours and 45 minutes. He took a whole lot of questions. We will be taking a break about halfway through for 5 minutes. So right about an hour and a half is, I believe, where the break point would be. We'll just take 5 minutes there. So expect that in about an hour and a half. A couple of quick things. Let's do a quick sound check, making sure you're hearing me okay by raising your hand, letting me know that you're hearing me, no echo. If you do have any issues with regard to the sound or the video quality, do just log off, log back on. But I can tell you from multiple days now, it has been superb with Zoom. Make sure you also have your backup plan in place. I do have one quick story. Somebody in California, people would be more appreciative of this here in the United States, but the power company PG&E was having their rolling brownouts, what they call them, where they turn off the power, and somebody one of our members was part of that, so was not able to participate because he didn't have any power. So you got to be mindful and think of it could happen as a contingency. What's your game plan going to be if that happens? This is applicable to trading in every aspect of the word. With that said, as soon as I start the replay of the video, when Mark starts talking, if you would just raise your hand one more time, letting me know that you're hearing him and the sound when Mark starts talking. Guys, not me, when Mark starts talking. And also want to let you know you can today continue to type in your questions into the chat box. You do have to reference your page number first, then your question. We will be gathering those in preparation for tomorrow. Just want to make sure you did get the email. I do know some of you still have not opened up your email, where that was sent out as an update to the itinerary. Tomorrow will be the next live question and answer session, this exact same time, 6 p.m. Eastern time. We'll open up the room 30 minutes beforehand, but you can type questions, additional questions that people might have forgotten or not had the chance to ask, rather in the chat box with the page number reference. So with that said, let's get started with the replay. Again, a 5-minute break in about an hour and a half. Thanks.
Okay, so Dave, I answered some questions. I answered some questions before at the end of the session, and so I'm going to give you a chance to answer a lot of questions. I'm going to be kicking a bunch of questions over to you, so they get a chance to hear from you because they heard from me.
Okay.
Only for about a half hour. We're going to do it longer today, of course. So we've already got just today, I think, 200 or 300 questions that came in, and that's only in the first 20 minutes. So again, we will not be able to answer anywhere near all the questions, but we also have, I would say that, some of these questions, sometimes there's 20 people asking the same question. So a lot of them are duplicative questions. All right, so let's get started here with some Q&A, and let's start right off here. I'll start one off for you, Dave. Sort of a I don't know about a tough one, but at the beginning of a correction, should you sell off positions or wait for stops to get hit? I'll let you start to answer that. So at the beginning of a correction, should you start selling off positions or wait for your stops to get hit?
I think you have to go individual, go through your whole portfolio. Because there are stocks that maybe haven't run during that last rally, and you have to ask the question of, well, why didn't they participate? You also have to look at the stocks that did have a huge run, and maybe some of your stocks in your portfolio are extremely extended and maybe even a climactic type of move. And those, I would probably, I would take those out for not sell them out, but maybe sell them down. Maybe you had a concentrated position and it had a really nice run. And so if I felt that the market or saw the market start to correct, then I would start trimming my portfolio on those extended stocks, pull those positions back, and then really examine the ones that hadn't moved. And as I said, ask that question, why hasn't it moved during a real nice market rally? And maybe that's another way you could reduce your invested position in the market, especially if you're on margin and you're being very, very aggressive.
Right. And I think there's two things to point out. And first of all, you have to realize I hate hypothetical questions. And, you have to assess the situation at the time. So if I had a bunch of stocks that were hyperextended, well, I'd be looking to probably trim those anyway. But the real question is, how do you know it's the beginning of a correction? You say at the beginning of a correction. Well, how would you even know it's the beginning of a correction? You only know it's a correction until after the fact. So in real time, you would not know it's the beginning of a correction. What is the definition of a beginning of a correction? Market down 2%, 5%, 10%. By the time it's down 10%, you've corrected. So you always have to default to the stocks. I'm looking at the stocks. And the other thing is, a lot of times you get a market correction and a bunch of your stocks hold up perfectly fine and they don't hit stops. So you have to really default to the stocks. Get off the market. What I hear you asking is scary. And I say scary, I mean scary for you that you're going to have trouble trading the market if you're worrying about corrections and not following the individual stocks. Take those indexes off your screen. Don't even look at them until the end of the day. Take them off your screen. Forget about the indexes. Screen for stocks. Trade the setups when things are working. You press it when they're not. You pull back your exposure. You pull back your activity. That's how you'll do best with trading leading stocks. Okay, let's move on to another question. So, what conditions might cause you to trade laggards versus the other categories that we mentioned? We mentioned leaders, of course, institutional favorites, top competitors, turnaround situations, cyclicals. So what conditions might cause you to trade the laggards or even the cyclicals versus the other four categories? Go ahead, Dave. I'll let you take that.
Well, in terms of laggards, never. One that's, one word answer, laggards. Why would you want to be buying a laggard?
Right.
Something that hasn't performed well. And then the other thing is cyclicals rarely, very rarely, unless they have just a perfect setup and you've had, 1 quarter or 2 quarters of big earnings showing a turn. But cyclicals should be a very, very small part of your portfolio. Where you make the biggest money is in growth stocks and stocks with these characteristics that we've talked about. And those are the ones where you're going to make most of your money. A cyclical, maybe, once a year I might be looking at a cyclical, but that's not where you make the big money in the market. You make the big money in these growth stocks.
Yeah, especially if you're playing them for the bigger moves. If you're playing them for the bigger moves, the growth stocks can make the secular moves because they can grow their earnings through thick and thin. Yeah, I mean, there's some examples. I'm not sure if we went over the Panera example or Apollo in the workbook yet, but you can look those up. These are stocks that went up 1,000%, 800% during the worst bear market in history, going from the 2000 top. So again, the cyclical stocks, there's a time and place for all these stocks to trade them. Another question, kind of an offshoot of this, can we assume that the examples given in the workbook are all leaders at the time of purchase? Well, I mean, if I'm pointing out a turnaround situation, there might be a turnaround situation in the workbook. So the workbook is whatever I'm talking about at that time. But yes, the majority of them are very, very well-positioned market leaders as far as, their price activity. So another question, and we might as well, segue right into it while we're on leaders here. Dave, what defines a market leader? We'll go back to, I know I spoke about it before, but real quick, how do we define a market leader?
Well, usually a market leader is a stock that has the strongest performance, a stock with the strongest relative strength. And then I would even throw in that it has the strongest earnings. When you're talking market leader, there aren't that many market leaders. We're not talking hundreds of stocks. And when I'm thinking of market leader, I'm thinking of 10, maybe 20 stocks that are the ones that you should be owning or you should be really concentrated on. That's it. Leading stock comes down to strong price strength, group price strength, and strong earnings.
Yeah, I should point out too that, so depending on where you're defining a market leader from, so a true market leader that Dave is talking about and that we talk about mostly during this program are the stocks that are leading the new bull market, coming out of a bear market and leading the new bull market and are the first to emerge. Those are usually your true market leaders. They can emerge from anywhere from before the market bottoms to a couple months after the market bottoms. Then as you progress, I know there was a question asking, if you're going to trade the market leaders, what happens to those who want to, you have to trade the market 6 months later or a year later after the bull market's been going? Well, that doesn't mean that there's not still stock setups and there's not leading stocks that are leading at that particular time that are showing really great action or maybe holding up really well in an intermediate term correction or a pullback, or the high relative strength stocks. So the high RS stocks are always considered market leaders. Then you have to assess them, whether they're late stage, whether it's a new move coming from a first stage base. We're going to get into this more in selling. There's, of course, we're only halfway through the Master Trader program. There's tons and tons more that we're going to talk about this stuff. And I think this is a good stock to talk about right now. When do you decide a leader is a laggard? For instance, Zoom is a leader, but everyone now loves it. Does that make it a laggard already? So a few questions in there that I hear. One is, Dave, so because a stock is loved and everybody loves it and it makes a big move, does that make it a laggard? No, that's no. What makes a stock a laggard, I mean, when it goes from leader to laggard, is when it starts rolling over and starts breaking down and starts breaking moving averages. And one thing that I've always mentioned, when you're using MarketSmith or you're using a relative strength number, I put actually a lot more emphasis on the relative strength line, because the line is against the S&P 500. The relative strength number is against all the stocks in the market. And so when you see a relative strength line, a trend line that's been so strong, broken like Zoom did, it really actually broke it long before the 50-day moving average was broken. It was broken probably in the middle of October, or the third week in October. That's when it starts going from a leading stock that everybody has to own to something where you do not want to own it. Right now, what's interesting is when I look at Zoom Video, the relative strength number is 99, but that stock is now sitting at 408, down from 588. And so this is no longer a leader because it is broken, and it is broken badly. So definition of going from leader to laggard is the price performance of the stock. Yeah, and I know there was some reference to some of these pages that are showing leaders going to laggards. And again, when you take a look here at something like a Qualcomm back in the day of 1999 going to 2000, I mean, that's a leader. Once it breaks, now it's turned into a laggard. Now, of course, you see it has a big move off the lows here, and this could be a new cycle. But again, if you were buying up here when this stock was an extended stock and late stage as a leader, if you didn't cut your loss, you could be caught in this and be waiting 21 years to get back to break even. So again, you have to put into perspective. Timing is really important, and we're going to get into that later. Let's see here. So what is the typical float of a leading stock these days? And I'll answer that. So we've done the work, and we continue to always study these big winning stocks and see what the characteristics are. So, when you go back, and I pointed this out before, you go back to the 60s, 70s, it was 5 or 10 million shares. It got up to 15 or 20 million, 10 or 15 years later. In the 80s, 90s, it was about 20, 25 million. It's not much more than that now, 30, 40 million, 50 million shares outstanding. The real key is that if all things are equal, you would much rather want to have a stock that has a small float than a large float, just simply because of supply and demand. If you had if you had a certain number of items to sell at an auction, obviously you can run the price up more quickly or charge more than if you had loads and loads of that same item. And so it's simply supply and demand. So you always would like to see the smaller float if possible. Let's see here. So that was page 41. Let's go to page 41. Yeah, so understanding when does stage 2 become stage 3 and how long can it take for stage 1 to form? Can a stock go from stage 2 to stage 4 directly? Well, yeah, I mean, it can. This was, sometimes stage 3 is only in hindsight. And you are in a stage 2 uptrend. And let me get that pointer because that red spotlight always looks better. You can always see it better. There you go. So yeah, here's a strong stage 2, and it very quickly morphs into that stage 4. But again, the stage 4 is more where you're getting below the 200-day. The 200-day starts flattening out or rolling over. The 50 gets below the 200. Sort of the opposite of the stage 4. So stage 3 is when you might get a big break in the stock and you get a lot of distribution and a wide base, but it has not yet really shown that the trend has turned into a bona fide downtrend. And that's the difference between those. I wouldn't get too, hung up in trying to understand the transition. If you want to understand transition, you want to really understand the transition from 1 to 2, because that's where you want to be involved. And by the time it gets to 3, you're probably going to be long gone out of the stock if you're selling into strength and using our sell rules. But 1 to 2 is very simple. I have 8 criteria. If it meets those criteria, it's in a stage 2 uptrend. That's all you really have to know. If it doesn't meet that criteria, then it's not in the stage 2 uptrend. Let's see. So in your use of the 150 30-week moving average based on Stan Weinstein's work, have you added additional confirmation to the more common 40-week moving average? So yeah, like I pointed out before, I met Stan Weinstein. I had read his book prior to meeting him many years before that, and had already been using the long-term trend as a qualifier. But I met him in 1990, and we had a really great conversation. I had lunch with him in New York City, and from that point, I started refining the trend work and studying the big winners and finding exactly what they had in common. So this isn't really based on my opinion. It's based on looking back and studying what stocks that moved up rapidly, what conditions were present at that time, and that's where I got the 8 criteria. Okay, so can you calculate the relative strength ranking by yourself? That's the IBD relative strength ranking. That's also in MarketSmith. I guess you could, but I don't know if you would want to. It's a lot easier just to use the software, but I'm sure you could calculate that. Let's see. So page 53. Let's go to page 53. We're trying to do this in order here too, so I can just scroll down. Okay, so page 53. These are, of course, the 8 criteria that you need to meet for the stage 2 uptrend. Question is, where did it go? Is the RS line referred to RS with S&P? Well, first of all, when we're talking about down here, note the relative strength line should not be in a strong downtrend. I like to see the RS line in an uptrend for at least 6 weeks, preferably 13 weeks or more. So yeah, if you see the relative strength line in a downtrend for 13, 14, 15, 16 weeks, that's a little bit of a red flag. Now, sometimes, like in the Netflix example that I showed you earlier, if you remember, it made a huge move off the lows, and then the market played catch up and it went sideways, and the relative strength actually, the stock actually underperformed during that period. That would not be a big red flag if it's forming a base and it's already made a big move. So there is some judgment that has to be made there, but the relative strength number, I think, is what's really important to see if there's a sea change. Like Dave was just pointing out before, we're looking at Zoom and it still has a high relative strength number. So for me, that may still be a correction within an uptrend because it still meets the stage 2 criteria and it also has the high relative strength. Usually when a stock tops, and it really starts breaking down, it's not acting right, you'll get that relative strength number that'll go from 99 or 95, high 90s, and it'll crack. And next thing you know, it's in the 80s and then 70s, and it might even get down to the 60s or 50s before it actually really gets into that stage 4 downtrend. So to answer your question, the RS line refers to the RS going against the S&P 500. Yes, that's correct.
And Mark, I would add, I'd be careful. To me, the relative strength number is something that you can do screens on, and it's more of a general number. But just like Zoom video, this is a great example. The stock is down from, let's say, almost 600 to 400. So that's almost a 30% drop in that stock. And the relative strength line has been broken, but the relative strength number is still 99. And it could be 99 for a number of months longer, or it could be in the 90s, for another 3 or 4 months, even if it goes sideways, because that relative strength number is calculated over a year. 20% is on 4 quarters ago, 20% on 3 quarters ago. Two quarters ago is 20%, and then the last quarter is 40%. So, the stock has made such a huge move. It's gonna have a long relative strength or a high relative strength number for a long time to come, even if the stock goes sideways from here. So that's why I put so much more emphasis on the line and what the line is doing versus the number.
Yeah, if you're trying to see what the stock is doing versus the market, you should be able to just look at the stock in the market and be able to make that determination. But the line will help you see if you're breaking the relative strength trend and so forth. So again, it's there is some judgment. These are just what we're showing you with the trend templates, and these mechanical sort of checklists are just qualifiers. These are just qualifiers you're going to screen. You're going to make sure that you have all these things in place before you start looking for a base and really analyzing what the quality of the base is and whether it's acting right. And then you're looking for, of course, the VCP pattern and breakouts and so forth. So there's a lot of work to be done that's manual. This is all just qualifying. Let's see. So Dave, this is a question for you. David said he likes longer bases. What is the time frame for a base that David likes? And do you, Mark, have an ideal length of base? So, Dave, what's the time frame that you like?
Well, I just if the stock has the earnings characteristics and has a 1-year base, and the stock is breaking into that 1-year base, I like that better than a stock that's already had a big move and has a 4-week base. I just find that sometimes you can get longer term moves from longer bases, and I've used the example in the past of Generac had been going sideways for almost 5 years and came out of a nice base back in June quarter of 2019 at 60, and then it made a move to 230. So it's just, I think if you're coming out of a long base, you could probably get a much longer move than something that's had a big move and has a very short-term base to it. It might be later in the game than it is on something that's just coming out of a longer base.
Yeah, the saying had always been on Wall Street, the bigger the base, the bigger the move. But there's a certain limits to that. But first of all, the bases that form are usually a function of the general market. If you have big bear markets, you'll have big bases. If you have smaller pullbacks and you're later stage in the bull market, you might have short bases. The other thing too is high tight flags, power plays. Those you actually want to be short. If they're long, they're abnormal. So you want those to be 2, 3, no more than 6 weeks. As far as the optimal base length, there really isn't an optimal base length, but a decent base is going to be 4 or 5 weeks at least. And generally speaking, I would say on average, probably 8 to 12 or 13 weeks. Now, again, it depends, and it depends the market. There could be 26-week bases. Generally speaking, they're not much longer than 52 to 65 weeks. Those are usually the longer bases are usually upwards to 65 weeks.
And on on stocks that have just gone public or have only been public for 3 months or 6 months, you're not going to get very, very long bases. So don't get don't get so fixated and I've got to get a long base, but I'm just saying that sometimes the longer the base you can, especially if it's got the earnings and the growth and such, then you might get a much longer move than something else.
Exactly. Yeah. The IPO basis could be just a few weeks. Let's see. So, question that was asked earlier, I heard Bob talking about, was Mark asking that the question was, why does Mark want to be in the market, or I think you said a stock, as little as possible? What I said actually was I want to be in the market as little as possible. Basically, what I was saying is I want to be at risk as little as possible. When your money's in the market, it's at risk. It's at risk. I mean, that's all there is to it. When you first buy a stock, it's all risk. You don't have any cushion in the trade. It's all risk. I mean, there's opportunity there, but you are putting your money at risk. So if I could be at risk, 1 day out of the year and make the same return as 365 days, I would take the 1 day, and 2 days if worse than that. But I want to be at risk as little as possible. So that's the whole idea, is to get as much reward as you can at the least amount of risk. People say, oh, not being in the market is risky because you're missing opportunity. That's absurd. That's ridiculous. That's a ridiculous comment, and it's only said by people who can't beat the market and need to expose themselves to the overall market and sit and buy and hold because they don't know any other way. And I understand that. If you want to make 9% a year and you hold the S&P and sit through 50% pullbacks, well, then that's the strategy for you. But you're at risk. All right. And I think this recent pandemic proved how risky it can get. And I've been through, the crash of 87 and the bear market 2000, 08. Dave and I have been through a lot of probably, 8 or 10 bear and bull markets over the last 30, 40 years. So a lot of things can happen. Let's see. So what happens if a stock dives after earnings and then recovers after that day, post-earnings drift? All right, so again, I'm not going to answer hypotheticals. I don't know. I have no idea what that would look like. All right, the questions have to be based on what I can see and take a look at and analyze. It's just too much of a hypothetical question. The very best way to get earnings guidance, is it on MarketSmith? Earnings guidance is usually announced as a news item. So if you're monitoring any kind of news feed, you'll see that, and that's something that you have to monitor, some news feeds. Briefing.com is a news feed. You have the fly on the wall, things like that. Let's see. Do you look at fundamentals before buying, or mostly for deciding to hold for a bigger move after you've already bought? All right, so Dave, I'm going to flip that over to you, but I'm going to say real quickly that, and I know what you're going to say as far as screening. Well, I guess we'll talk about screening and then also holding for a bigger move. I'm not looking at the fundamentals after I bought. I'm looking at them before I bought. That wouldn't make much sense. But as far as you're concerned, Dave, you're looking at the fundamentals before buying, or?
Oh, yeah, definitely. I mean, when I'm going through hundreds of stocks and hundreds of charts, during the week or on the weekend, first I'm looking technically how strong is that stock, and I'm concentrating on the right side of that chart to see if the stock is starting to set up. But immediately the second thing I do is I go down to the bottom of the page and I start looking at the quarterly earnings. How strong are the quarterly earnings, which are the fundamentals? Then I'm looking at the annual earnings, and I go through the progression of looking for those CAN-SLIM characteristics. So the fundamentals are very, very important. Yes, you can buy just off the chart, and that could happen if you're if you're looking at a biotech. But I usually like to have earnings with my setups and with the stock technically set up, because as we've seen in studies, the greatest winners come when you have a combination of both the technicals and the fundamentals.
Yeah. Dave leans more towards the combination, what we call techno fundamental, where you have the earnings and the and the technicals. A lot of times when he's given me, talking about stocks and suggesting names to me, they'll almost always have the earnings. I, on the other hand, lean more towards the technicals. I'll trade a lot of stocks that don't have earnings. I'm swing trading and a lot of shorter term trading. But if, again, coming off of a bear market low and trying to find those big leaders, I prefer to have the earnings, especially if, you're going to hold for a bigger move. So speaking about earnings and fundamentals, page 98, let me just go to page 98 here. So the question is that when do you check the code 3 matrix? Is there during the setup or forming of the stage 2? Is there a good setup but lack of code 3 matrix? And if not a biotech stock, would you consider buying it? If it was other than a biotech stock and didn't meet the code 3. Well, most stocks are not going to meet a code 33, what we're talking about, where you're getting earnings, revenues, and margins all accelerating. The majority of stocks are not going to meet that. That's a very elite group. And even though they may meet that, they may not be technically set up. You might not have the right setup and the technical setup where you're going to have a VCP and a low risk entry point. So none of this is like, if it meets, run the code 33 matrix and buy those. If you think that you're going to be able to use that like as a strategy and program it into a computer, it's not going to happen. Okay, you're not going to do well. This needs to be done by hand. I'm giving you a lot of tools to be able to find and locate potential leaders, but you still have to look for low risk entry points, manage the risk, manage the position, and so forth. But to answer your question, I'm screening, and when I'm screening, I can see if you're using MarketSmith, which I would suggest you do, because it has everything on one place and one page pretty much. And you can see the margins, you can see the earnings, you can see the revenue, and you can see if that acceleration. So I don't really even need to run, although I have a code 33 screen, I don't need to run it. I can just look and see how many quarters are accelerating. I immediately know. Real quick too, I think during live trading day, next Monday, Arusha's coming from MarketSmith. We're going to go over MarketSmith, but I believe there's going to be a special offer. They usually give a special offer to the MTP participants. So you'll have a chance to sign up for MarketSmith and get a little bit better deal, I think. So if you want to just wait for that. Let's see. So does a predictive setup mean pending general market turn, or do you still need to see a healthy number of market setups to confirm? All right, so that's on page 106 where I talked about, let me get to that, where stocks can actually set up in a predictive fashion, a coincident fashion, or a confirming fashion. And this is really, so when you have a bear market, all right, or you're in a big decline, I'm already looking for stocks. And, some people say, well, this goes against the O'Neill follow-through rule. No, it doesn't. Okay, so a follow-through day, I'm still looking for a follow-through day, and that might give me more confidence to even buy a few more stocks that are setting up. But you have to live with these stocks and with the market as things are progressing, and that's how you know where the leaders are. You're seeing the stocks that hold up and are setting up even before the market makes its low sometimes. Sometimes it doesn't work that way, and the market corrects, and a lot of stocks set up right up the right side, and sometimes you don't get anything predictive or coincident. I'm showing you the 3 areas where they can happen in one or all 3 of these areas. So when you get into a correction, you're starting to look predictive, you're looking coincident, and you're looking confirming, and that just simply means that the market coincident is coming off the lows. You won't know that at that time, though. When the market's turning up off the lows, and even if you get a follow-through day, you don't know if it's going to go to lower lows and everything's going to fail, or maybe the averages go to lower lows, but your stocks don't hit your stops. So again, this is always going to be a work in progress. It's always going to be something that you're doing in real time. Dave, real quick, you remember 1990 where we had so many of the healthcare stocks, U.S. Surgical, Healthcare Compare, U.S. Healthcare, Ballard Medical Products. We can go on and on and on with all the names, Amgen. Remember how they were all setting up bases and actually moving into new high ground? So I think you made a point about 3 lower lows. I think we had 3 lower lows going into the bear market in 90. Coming off of the second lower low, a lot of those stocks broke out. And then when we went to the third lower low, they held up. They held their breakouts. They held their stops as far as my stops were concerned. So I guess the question is, how do you play those? I mean, are you looking, once the market's in a correction, when do you start looking for these leaders?
Oh, you start looking for leaders immediately, because that's some of the most obvious times to find leaders are the stocks that are just going sideways or resisting the decline. And you'll also see that happening by their relative strength numbers and their relative strength lines starting to move higher. And lots of times, as you mentioned, weeks and sometimes months before the market actually bottoms, these stocks are starting to turn and resist the decline. And so I start looking, immediately when the market starts going through a correction to see what's holding up. What could be that big leader, that big winner when the weight of the market comes off?
Yeah. So there's another question here about let's see, page 107 and 108, or a comment that says, seems dangerous to buy a stock breaking out while the market is under pressure. Well, you say that, but when you look at this chart, it doesn't look so dangerous, does it? I mean, again, the chart is contradicting that. If you're in the right names and names are holding up well, it may not be that dangerous at all. I mean, I understand what you're saying, but again, you're thinking market, not stock. Leading stocks lead. And some stocks will hold up even during a bear market, like Walmart did here that you're pointing out. I mean, you're asking a question or making a comment, but then making my case by showing the charts. Again, you're looking at, you said page 108 also, seems dangerous. I mean, does this seem that dangerous? This stock breaks out and never even comes back to your breakout point. Apple, then it breaks out again and never comes back to your breakout point. You are never put under any pressure whatsoever. You never even, your original purchase price is never even challenged, let alone your stop. So I don't understand how this could be dangerous at all. It's just the opposite. And that's during a market correction. So again, like Dave said, we're looking right away. As soon as the market's correcting, we're immediately looking to see what's holding up. That doesn't mean you go in there and you start buying hog wild, because you're probably not going to see many setups anyway. And a lot of times they don't set up until the market either puts in a temporary bottom and starts rallying off of one of the lows, or you get the final bottom.
And Mark, I think, as you said earlier, that I think people put too much emphasis on the general market. Where I get my greatest feel for the market is by going through hundreds of stocks every week and seeing, are there stocks that are setting up? Are there stocks in uptrends? And that's where I get a great feel for the market. Even if you buy a stock, even if you're in a bear market, but a stock is setting up and it starts breaking out, at least take some size position. Yes, maybe it's going to be held down by a bear market. Maybe it's not going to make much progress. But when the weight of the market comes off, sometimes those are like slingshots. They just take off and go when the weight of the market comes off, and you've got a market leader. Market leaders start showing themselves before a bear market's over or a correction is over. And those are the ones you want to focus on and concentrate on.
Yep, absolutely. And the question here, page 119, we're going to go to, and this shows, of course, what to look for during a correction. So the question is, and this is a good question, most super stocks, 98% of them come off bear markets. The coronavirus bear market was a half a year ago. So what do we do now? Keep buying stocks in stage 2 with VCPs. So Dave, we talk about how, the majority of these stocks, upwards of 96% of these big moves, start from corrections. Okay, so the big correction's over. So now what do people look for later on? And you're in, like we talked about this before, just a little while ago. What do you look for once you have the correction, and now maybe those leaders have all taken off?
Well, what you do is you wait, because if a market and an individual stock is going to make a nice move over the next 6 months or year and a half, you will get an opportunity sooner or later. There'll be some news that corrects the market 3 to 5%, and some of these leaders will correct more. But you'll have another chance to buy them after they've formed a base. a market leader doesn't go straight up week after week for a year and a half. In most cases, they have a really nice move for 6 weeks, and then they pull back for 4 or 5 weeks and go sideways. So what you do is just you get a watch list together of the stocks that you wish you were in that seem to be market leaders, and look at them day by day and wait until they set up proper bases for you to get aboard that stock. Because even if you miss the first base or the second base, you can still get a third base. And sometimes there are multiple bases along the way that will give you buying opportunities to get aboard. So you just have to be patient and do your homework and look for these stocks as they set up new bases.
Yeah, I think this question illuminates several things. Okay, first of all, like Dave said, there's going to be multiple bases along the way that you can trade, and some are more tradable bases as the trend progresses, and you get. And we're going to look at base counting later on. But let's just say you have that first base that forms. You get in a stage 2 uptrend, and you have that first base. Okay, that's what I refer to as sort of an investment grade, and those very often will come off of the big bear market low. Then the stock makes a move. Now you're going to get other corrections in the market. Doesn't mean that a correction has to be a bear market. You're going to get intermediate term and short term corrections. So now you get your normal 5-6% pullback. That might give you an opportunity. Or a little bit later in the market trend, you might get a 10 or 12 or 15% pullback in the market, which will form usually some pretty good bases. And a lot of times you'll get bases to form in the stocks that are already shown you that they're leaders. So you get another chance. When you get into the 4th, 5th stage base, now you're getting late. And those are the ones that are really you want to just trade out of. They're not investment grade anymore, and they're late stage bases. So yeah, again, you have to make a determination of where you are within that maturation cycle. We're going to get more on this. Don't worry. We're going to cover this stuff. So does the VCP pattern have to consist of higher lows, or is that or is a violation of that allowed? So that's on page 126, right? Let me just see here. Hold on. 126. So the VCP. So in order, by definition, to have a contraction, all right, yes, you have to have a higher low, because, for instance, let's just say, you come down to this point here at 1. That's your first measuring point. Hasn't contracted yet, but that's your first pullback, all right? So now you rally. So if this were to go to another low, well, then 1 would be from here to that new low, right? But as you now rally here up and you pull back, now that's your next contraction. I mean, you could even call this, maybe this is 2 and this is 3, 4, 5. If this pullback is larger than this pullback, well, then this would be 2, and this would just be part of that rally. So that's basically what you're looking for, is for each measurement to get smaller than the previous from peak to trough. And you're using your absolute high to absolute low. So yes, they need to be higher. Can we buy a low cheat after base 1? I'm not sure what that means, but it's on page 126, so it's right here. So I think I understand what you're saying. Let me get draw a trend line. I think you're talking about right here. Why is that yellow like that? How do I change that? Oh, there you go. All right, so yeah, right here. So yeah, that is a low cheat. And I would say that's a very good eye of seeing that. And yes, that's a buy point. That's absolutely a buy point. And you see, it's much lower within the base. Now, you do have a lot of overhead to contend with on the left side. So the chances of this working are less. And I talked about this, David and I talked about this before, where, what the cheat, the low cheat, the handle, which is a higher probability. The cheat and the handle are about the same. The low cheat might be a little bit less. You have some, especially if you have some overhead to contend with. And you see how it comes up, and then it has to come back down and sort of reset and go through that whole process again. That's the ringing of the towel. That is the supply being digested until finally it's all taken out, and now the stock can move freely. But yes, that is indeed a buy point there. Let me just get that out of there. Let's see.
And Mark, the question does, if I understood it right, does the VCP have to be going up?
higher lows. With
higher lows. Yeah. But lots of times you'll see bases that just go sideways. So you won't get higher lows, but you'll get that tightening or even the drifting off where they're actually making, just slightly lows, like you pointed out in that low sheet that's not labeled. Because I think a proper consolidation is sideways to drifting down. You don't. It's a very minor. It's a fairly important point, but something to watch out for. And maybe we can find another example where you have something that's wedging up, even though it's tightening up, it's wedging up, and that's, to me, you got to be a little bit careful of that.
Yeah, we do have a good example, and I'll find it later. I think there's a question on Dick's Sporting Goods on why not to buy earlier in the base, and it has a wedging right side off of guidance of the company issuing upside guidance. So we'll get to that, and we can let you talk about that. But this is specifically on the VCP. Dave mentioned that after he confirmed VCP on the right side, he will compare it to the left side to see if it is in the upper half of the chart. Can he elaborate on that? And does that mean that the price should be near the 52-week high?
Yes. Then this would, this would eliminate load sheets. I think right. the stronger, the stronger the position, or where the closer the stock is to its old high. So if you're looking at even the Central Garden and Pet, that you can see it's in the upper half of that entire base that looks like it's gone from 16 all the way to 12 and back up to close to 17. That to me is a good solid base, because you actually have very, very little overhead from that point. But as you mentioned earlier, if you're going for a load sheet, you do have overhead, and it could come up against resistance and pull back and shake you out. So to me, this is the best buy point, especially on this chart. Same thing, yes. Yeah.
And sometimes you have a load sheet that doesn't have a lot of overhead. The overhead's a ways back, and just the way the price set up. Here is where this is technically, I'm going to show you here, and we're really going to go off the reservation here, but right here, that's a load sheet. That's a buy point. Now, again, that is a buy point that is an expert buy point. You have to realize there's definitely a lower probability of this working. When I say working, I mean taking off before it challenges your stop, or you can see here it runs up a bit, but then comes down here. See, that's where it meets this supply. And then if you were to what we talked about before, you just draw a line like right across here, and you start to see where, the majority, and I don't know how to move that line, actually. Hold on, I'm going to clear that and do it again. Hold on a second. Let's take that. And so we just draw this line right across here. And you see the majority of the price action has happened right around that 53, 52 level, give or take. That's where the majority of the price actions happen through this entire base. So when we finally tighten up right here, just above it, we tighten up right, that's where that specific entry point is. That's what specific entry point analysis is. Let me explain to you real quick why did I come up with this term, specific entry point analysis, or this technique, and try to get so pinpoint on these buy points. The reason was poverty. Okay, I started off very poor, and I had two things. I had to make money quickly, and I had to make sure that I could compound it very rapidly. So I realized, I did the math, and I said, okay, I've got a few grand here. To make this into something worthwhile, I got to compound the heck out of this money. So I wanted to figure out how I can minimize my downtime and constantly be rolling into stocks that were on the move, and to know immediately if I was right or wrong as quickly as possible. I wanted to know if I was wrong, good. Stop me out that day if I'm wrong, because then I can move on to something else. So I started to really study and to figure out when these stocks really started moving fast and in earnest, and that's what led to the these very specific buy points. And when I first approached Dave to write the foreword to my book, he wasn't interested, and I don't think he believed that anybody wrote a book that was even, could be even near as good as O'Neill's book. I had a hard time believing that myself because O'Neill's book is so wonderful. But then I sent him my manuscript and he said, wow, this is like, the next level of O'Neill. It's so forensic. And I think, Dave, you said it's the book I always wanted to write. He said, now I don't have to write one. You wrote it.
Right. Exactly.
So, but this is sort of, and I'm sure, somewhere down the line, someone's going to write a book and going to take this work to another level. I'm not sure how, because I think we've got it down to the exact buy point here. But I'm sure that there's going to be advancements and somebody else will further my work. So anyway, that's, in the VCP, I came up with this simply to teach people. Because I found so many people were misdiagnosing stocks. They were saying, is this a coupled handle? Is this a correct base? Is this a right pivot? And most of the time, no, it was nowhere close. Even after VCP, a lot of people get it wrong, but a lot more people get it right since the VCP concept. This has, for some reason, has made it, brought it to life where people can now see it better, and they go through that count, and it just makes it easier to find for whatever reason. I guess it quantifies it a bit more. Let's see. So page 130. I know we get a lot of these questions. Are stocks buyable earlier? September 3rd. Over here, so I would say no. I that's a little too sloppy for me. I like where it tightened up here, so I would say no. That's not ready to buy there. Let's see. So on 130, same page, should I set the initial stop loss at the last T before the pivot point, or should I use a 7 or 8% stop if it drops below that point? So the last T is right here, and that would be basically the same thing because that low is 8% from the breakout. So even if you paid 1% above that, it would be a 9% stop. So Dave, this is a good time to talk about, and I'll give my word on it too. But so when you get into a stock like this situation here, Netflix, let's just say this is, this pullback is 10% or 12%. Are you using the low and the pivot as your stop, or you defaulting just to a mathematical number or dollar amount? How are you approaching that?
It all depends. It all depends on that base. If that base is really, really tight, and let's say that low was 46 and the buy point was 48, I would actually use at least to start selling part of it at 46. I don't have to wait till it gets to 8%. So it depends on the tightness of the base that I'm buying out of, and then if not, then if there isn't a shorter sell point, then I do use that 8%.
Right. So there's a few things to point out here. One is you don't have to sell all at one price. Now, we're going to get into, again, a lot of these questions are all going to be answered later. But we'll answer them now, and then we'll have curriculum on them later on during risk management. So you don't have to sell all at one price. Right? There's something that I call staggered stops or bracketed stops. So sometimes what I'll do is I'll get into a stock and say the low is a clear cut out. Maybe it's the low in the base or the low in the pivot, but it's 10% away. Well, then I might sell, and my goal is to keep the loss limited to, let's say, 8%. So you've got a 10% clear cut out. So now if I sell half at 6% and I use that other technical level at 10% as my out, that's 16% divided by 2 would be 8%, right? Half and half of the positions. I would still accomplish getting that 8% loss, but I would give the stock a little more room on half the position below the 10% stop. So I can give it the 10% stop. And that's when you blend the stops or use what I call staggered stops. That's one way. The key is that you want to the stop, and I always talk about risk first, backing into risk. You're backing into the risk, right? You're selecting stocks based on the technicals being tight enough where, again, they give you that technical out. And if they don't, if you're enamored by the stock and maybe the technicals are a little too volatile for your risk appetite, well, then you have to switch over to a mathematical stop, and you just say, look, I'm out at 6%, or even a dollar stop. For many years, when I first started trading, I used a dollar stop. I would just say I'm going to risk. I'd go in and I'd come up with a dollar amount that I was comfortable with, and that I basically had to just trade what I could stomach, because I didn't want to get an ulcer from trading. So you could say, well, the percentage is 8%. And but you have $1 million portfolio and you're taking 25% positions, and you're talking about a $20,000 loss. Well, some people they'll end up with sickness if they take those type of losses. You get stopped out 4 or 5 times in a row and you're down $100,000. Some people will get very ill from that. So you have to figure out what your risk tolerance is too. So that's just elaborating on that a little bit. We're going to get into that more anyway. Is the handle or the pivot, should it always be single digit contraction? Now, I prefer a single digit pivot for the reasons that I just said. But there are times where it might be 10 or 12% or even a little bit more. But generally speaking, if you start getting into a 15% handle, that's not really a handle. That's sort of getting into the depth of a base. How do you feel about that, Dave?
I'd say the tighter the better. If that contraction is 1% or it just flat lines, that's better than a 10% pullback in that consolidation.
Right. So now the question is on 139, the first VCP setup in stage 2. I'm not sure how that is stage 2, if it still looks like it's moving sideways. Okay, well, it can look whatever it wants, but the fact is it meets the 8 criteria. See, that you don't have to guess. I gave you 8 criteria. If it meets the 8 criteria, it's in a stage 2 uptrend, and that's all you need to know. And then from there, you start looking for a base. Let's see here. So what's the minimum pullback allowed in a base? All right. So the maximum pullback. So we talked about this before. Dave said anything over 50% he's not interested in. I'm pretty much the same. Maybe like I said, in the big bear market, you see a lot of stocks are having those big declines. You might get those big declines like, this isn't really that large, but let's just say this decline right here was 50%. Well, if the market was a big bear market and a lot of stocks, maybe the biotech sector, all the stocks had big 50% declines, I might entertain this, but a big decline is going to need a big right side, and you're going to need to see some symmetry, and usually you're going to get multiple tightenings. You're going to have to go through that wringing of the towel. There's a lot of supply, so you're going to have to wring that towel out. Like we talked about before, you're going to have to wring out that towel. I know we had some questions about what these little abbreviations mean on this slide. So trapped buyers, we talked about the trapped buyers on the left side, right? Supply, and then bottom fishers, buying off the lows. And then up here, as you come up the right side, you have profit taking and loss cutting. So you have profit taking from the bottom fishers that are at a quick profit. And then you have loss cutting from the people that were trapped buyers, and it's coming back near their price. And they're maybe getting even. And then that same thing happens over and over, just on a smaller level. That's why you're getting smaller pullbacks, and it's lasting less time, because there's going to be, obviously, if this is a 50% decline, a lot more trapped buyers with bigger losses, and the bottom fishers are at a larger gain, right? So there's more potential for profit taking. So then when you get into the next pullback, right, you've weeded some of this out. So now you've got some people that are still trapped here, or maybe bought it here. You've got some bottom fishers here, but they're not at as large of a gain. They're not at as large of a loss. So now a little shorter time goes by, and it's shallower, and it just keeps going through that until finally the supply is out of the stock. There is no more supply. This concept of supply not coming to market is so key to understanding VCP. When you fully understand the reason behind this, you will fully grasp that this is not a technique that works because people are using it. It's not the cause, it's the effect. Okay, so it's the effect of supply and demand. It's not the cause. Once you understand that, you will know that this is timeless, and that's how you'll make a commitment to it for the rest of your life, and know that this is a technique that will work forever. And that's why it's so powerful. let's see here. Faulty base concept. Okay, I don't like to get into looking at the wrong way to do things or why something is faulty. I think that it's more important for you to look at charts of winners as opposed to, well, why is this faulty? Okay, I understand there's a million reasons why a base could be faulty, but there's only a small handful of reasons why it's right. And we need to concentrate on that more than anything. I know, what page was that on anyway? 143. We talked about why these were faulty, all right? One, wedging up the right side, a big decline relative to the market. I mean, 50% decline when the market's only down 10%. That tells you right there that's not normal. So again, I just point out that if a whole bunch of stocks are down in an industry or the market's down real big, you have a big bear market, well, then you can maybe cut the stock some slack and say, yes, a 50% decline, I can maybe trade that or buy that stock if it sets up. But again, as I pointed out, you need a big right side when you have such a big decline. Is that a big right side? No. It's just coming up the right side, right? It's a wedging rally, and it fails miserably because it goes right back into that supply on the left side. I'm not going to get into too much of why something is bad. I want to focus on see and getting your eyes to see what you need to see, not what you need not to see. Let's see. So on page 144, it's the same thing though, I think. Dave commented, it doesn't have the look. I understand T signatures, but do not understand the look. Can the look be summarized? Okay, so again, I'm going to give this to you, Dave, but Dave always will say to me, when we talk about stocks, I'll say, hey, what do you think of this? And I'll be, nah, it doesn't have the look. We use that term. I use that term now. That's what he always says, but I even use that term now to say, does it have the look? I think that's developed over time as you become more skilled at this. I don't know if could we actually, determine, quantify the look, Dave?
I don't know if you can quantify it, but I think what it is the way you develop it is and this is what you should be spending a lot of your time on, is looking at proper bases, looking at greatest winning stocks, and just concentrating on their bases and what did they look like before they made their major moves. And I've used this example before when they teach, people at the Treasury Department to look for counterfeit bills. When somebody's counterfeiting bills, what they do is they don't have them study the counterfeits, they have them study the perfect bills, and they get that ingrained into their mind. That's what you should be doing, is getting ingrained into your mind the perfect base and those bases of the big winners, because then when you see it, you'll identify it and you'll say that looks exactly like so and so winner from 5 years ago. But when something doesn't have that look, it's a faulty base. It does not look like a great winning stock, and it's usually wedging up in the handle, or the volume is too big on the, as the stock is correcting as it's setting up a base. I mean, there's just a ton of things that you could be looking for, but you got to get that ingrained in your mind, what a beautiful base, a perfect base looks like before it makes a big move.
Yes, and I was hoping you would go with a counterfeit bill analogy, because it's one of my favorites ever. It's such a great thing to talk about on how when they look for counterfeit bills, I mean, if you know what a perfect bill looks like, then anything other than that is not a perfect bill, right? So again, this is in my book. I know I heard Bob talking about my mindset book. I talk about how to practice, how to have perfect practice. And that's a big part of the concept of my whole strategy towards life, towards anything that I try to accomplish, whether it's the shooting competitions I do or, tennis. Dave's big with tennis. He's a great tennis player. I'm looking at the best players, the best operators, and trying to figure out, those few mechanics and to master those, not going and looking at the worst players and saying, let me find out all the things that all the crappiest players do and not do those. That's ridiculous. You could never become good at anything with that mindset. It's a terrible mindset, and so many people go in so many things with that kind of a strategy or mindset, and they don't realize that they're just sabotaging themselves right from the beginning. And again, focus on finding the perfect setups. And a good friend of mine, Jeff. Hi, Jeff. He's here today, I believe. He's been on the attending, and I just spoke with him the other day, and he asked me about a stock, and I said, look, you have the workbook. Go to the workbook, and does it look like the stocks in the workbook? See if you can find a precedent. If not, well, then it's not a great setup. There's so many setups here that I'm showing you in this workbook. There's hundreds of examples under so many conditions. Can you find even one that looks like the current stock that you're looking at? O'Neill's book has a whole bunch of charts in it. And of course, my two books have a tremendous amount of charts in them, some that are on here also. But again, try to get that and print it into your mind what those perfect setups look like. So do you prefer weeklies over daily? So I always look at both. And there are some nuances that I will look at on a weekly, and Dave too. We look for volume markers on the weeklies. We're usually looking for big volume, maybe in the base, to see if there's big down weeks, and just looking at the quality of. And again, we're not going to be able to impart all our experience on you. We'll be able to impart our knowledge and give you and quantify a lot of things and take you to a new level of knowledge and give you a whole bunch of examples and a lot of information. But when it comes down to knowing the look and being able to go in there and forensically look at a base and see one volume bar that that's suspicious and that's really something that I got to be careful. That takes experience. We're not going to be able to impart all that experience. Unfortunately, experience has to be earned. It happens over time. You can't force it. You can't become a great tennis player just because John McEnroe is teaching you and he tells you everything he knows in a weekend. Just isn't going to happen. You're still going to have to practice, and it's going to take years. So same thing with this. As far as weeklies and dailies, I'm always looking at both. And I know Dave is too. How do you
I even go out to the monthlies too, just to see the big picture. I want to see every aspect, and then sometimes, and then to when I'm really even getting down into the super detail of the breakout, I'm looking at intraday charts to see if I can discover anything there. But I think you concentrate mostly on the weeklies and the dailies. That's where you should be making your most of your decision.
Yeah. I'll look at the monthlies too to get that long-term perspective. But yeah, I'm looking very forensically on the dailies and the weeklies. I'm looking to see the longer-term trend and the quality of the base and analyze the volume on the weekly level. But again, you want all the time frames to look good. Some people say, "Oh, take a look at this." It doesn't look good on the daily, but the weekly looks good, or vice versa. So let's just say, the daily looks great, but it's in a downtrend below the 200-day moving average. That's not something that I'm going to consider. So you have to take it all into consideration. Let's see here. Does massive volume in the drop at the beginning of the cup on the left side give you pause for concern? All right. So let's see if there's a page. Okay. 147. Hold on. Let's get to that. All right. So I wouldn't call this massive volume to begin with, and I wouldn't call this a huge drop. But Dave, does this, and I think there's two things we should talk about. One, if you're going to see massive volume in a drop, you'd want to see it on the left side. That's where it usually happens. And does this give you reason for concern? I mean, I guess if you already owned it right here, I wouldn't like to see that. But again, as far as analyzing the base, and we're looking at it as a buy candidate over here on this left side here, does that give you reason for concern to buy this stock over here?
No, and that's lots of times that happens after a stock makes a really nice move. And look at the perspective of where this has come from. This stock has had a 50% move. It's come out of 10, it's gone to 15, and then it starts pulling back. And yes, it's very natural for a stock to get hit on volume one day, a couple of days. Now, what you don't want it to do is you don't want that volume on the downside to persist. A couple of days is fine. Then look what happens at the rest of the base. The rest of the base, it looks like it just really dries up. The volume really dries up. The stock tightens up, and it goes through your VCP pattern, and that's fine. So 1 day, 2 days is fine. It's just look at the whole base, and if it doesn't continue on, then in terms of big volume on the downside, then that's fine.
You can it's still in an uptrend. It's in an uptrend.
Everything is. It's a beautiful base.
Yeah, it's perfect. This is perfect. Again, like I just said before, look at your stocks. You can compare them to these precedents. That's what I do. I compare to precedents. I have these precedents in my head. My head is like a Rolodex of precedents. I'm very good at, some people said I have a photographic memory. I think I might have a photographic memory for charts, but not in life. But I was a musician all my life too. So I found that musicians can read charts pretty good, I think, because if you can read music, there's been some people have talked about that. I think Linda Bradford-Rasky also talked about how musicians, he feels they can read charts well. But again, to get back to the volume, if you're going to see heavy volume and a big decline in the base, you're going to see it usually down the left side and around the lows. You'll see a lot of volatility, and that's where the volatility should be. And then as you get to that right side, that's where you want the contraction to happen, and then you want the volume to start calming down as it gets over to the pivot. Let's move on. What is a pause pivot? A pause pivot is simply a very short pause, very short pivot. So it might only be a 1 or 2 days. And yes, you can have a pause pivot. I'm not sure if we have an example of that. If I see that, I'll point that out as we go along. So another. Excuse me, another page 147 question. How do you make sure the breakouts are good before I buy in terms of volume? Good close, bad close. Well, obviously you don't know the close until it closes. So the answer is you don't. You have to buy it intraday. You can extrapolate volume. So for instance, let's say in the morning, the average volume, let's say, trades 500,000 shares. And by 10:30, the stock starts breaking out, and moves above the pivot point. You buy it, and by 10:30 in the morning, the volume is 250,000 shares. It's already done half the volume in the first hour of trading. That's running at a really good pace. So you would know. So Dave, if the stock breaks out early in the day, I mean, are you going to not buy it because you don't see the volume yet?
No, I'll start a position. I'll take an initial position, especially if everything else is set up. If the base is beautiful and the earnings are there, then no, I'll go ahead and I'll start buying it. And then I might buy it, 2 or 3 times throughout the day as it progresses, if it's doing everything right.
Right. And let's see here. It's okay. The page is 147. I'm not sure, maybe because of this big move here. That's the question. But how far above the breakout pivot do you say a stock is extended and should not be bought? In general, define what extended means. So I'll give you my take on it, and then we'll let Dave give you his opinion. I'm not buying more than 1 or 2% above virtually never. I'm either buying at the right price or I'm not buying at all. Now, if I have a big position to buy, maybe, and big is relative, but let's just say I have 5,000 shares to buy or 10,000 shares to buy, and stock starts moving and I can only get 500 shares at the price, and then it gets away from me. Well, then I end up with 500 shares. That's it. I don't chase it. And as far as extended is concerned, once you get away from the base or even the respective moving averages, like if you're a good distance from the 20-day and you go back and you look and you see that, every time the stock has been that far from the 20-day, it's pulled back. Well, that can give you an indication that it's getting extended, all right, or the 50-day moving average. But again, if you're getting far away from the base, and the further you get away from the base quickly, that's getting extended. Now, in a breakaway move, you want to see that, but you don't want to be paying up for it. You want that to happen after you buy it. You want to buy it as it comes to the base, and then getting extended, having a really strong move coming out is great. Dave, what's extended to you, and how far above the buy point are you buying?
When I first started in the early 80s, I think Ed O'Neill extended at that point was 10%, but the market seemed to move a little bit faster. And so I would say the closer you can get to that buy point, I mean, if it's 1 penny above that pivot, that's where you should be buying. I wouldn't go any more than 5%. Once it starts getting past 5%, then you start running the risk of the stock squatting or the stock pulling back and sitting on top of the base or shaking you out. So the closer absolutely is better. And if you miss it, well, look, there's thousands of stocks out there. You can also, what a lot of these stocks have been doing these days is they break out and the next day they pull right back down to the buy point and you get a second shot at it. So don't get discouraged if you start missing some of these. You can set buy stops to, if you got another job or you can't sit in front of the market all day long. You can set buy stops and sell stops and help you get into some of these positions as they're moving out.
Yeah. Question asking, what is a natural reaction? Is there any definition? Well, a natural reaction is just a pullback in the stock after it breaks out. And that can usually occurs above the breakout or just slightly below it, maybe on the first pullback. Here's a pullback that looks, it looks a little scary here. If you bought this stock, it comes out for a few days and then wham, comes right back in. Well, you don't know it's a natural reaction until you see if it can get back into new high ground relatively quickly, usually within a few days to a few weeks, usually a couple days to a couple weeks. Now, again, if this came in another few days and you get a pivot failure, the more it comes in, the more technical levels it breaks, the more the percentage decline, obviously, the more likelihood it's not natural. But usually those pullbacks are confined to pulling back above or just below the breakout. Sometimes you'll come in and you'll undercut, you'll be at a small loss. But again, you want to stick with your stop. When you first trade the stock, you come up with an amount that you're going to risk and you stick with it. And now, unless the stock has a violation or gives you a profit that you're very happy with, and it makes mathematical sense to take that profit versus how much you risked, you should be sitting with it and then allowing the stock to pull back and then see if it can get into new high ground. These are all natural reactions. One here, 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 here. These are all just pullbacks where within a few days or so you're back into new high ground. A little pullback here, a few days back in new high ground. Little pullback, back in new high ground. See, these are all natural reactions. Now, once you understand what a natural reaction looks like, you will be able to understand what an abnormal reaction looks like. Okay, but if you want to go and study all the abnormal reactions, well, then you'll go study 9,000 different reactions, and you'll never be good at any one of them. So again, going back to my philosophy of studying the best, seeing what looks right, and then everything else other than that is wrong. That's the way to look at it. Let's see here. Okay, on page 150, there are two inside bars, and you bought above the high, but many times you were waiting for more tightening. Can you give guidance on when you would put a buy stop versus wait for more tightening? How do you know the stock is ready? This is a great question. How do you know to buy here, after these few inside days versus waiting for maybe another inside day or a few more inside days? If you want, I'll give you a crack at that first, Dave. How do we know to buy here as opposed to waiting longer?
Well, you look at the whole base and you can see that the contractions are getting smaller and smaller. And it's also forming a nice little, you can see a little cup and handle in there, and you're right below the buy point too. So if it goes through that buy point, then then you should go ahead and buy it. I mean, it's the whole picture that you're putting together to get you to that point of where, hey, there we go. The other thing too, as you pointed out, lots of times you do get inside days where there's just really very little movement between, an inside day is it trading inside the high and the low of the previous day. And you actually have 2 inside days in a row before that stock breaks out. And so it's a combination of a lot of different things, but how much tighter do you want that thing to get? I mean,
exactly. I mean, that's pretty tight.
Yeah. I mean, if you wait any longer, then, stocks don't get as, that tight. So, it's the whole look, and it's actually going through the buy point as it leads you to say, I'm not waiting any longer. I got to go right now.
Yeah, and again, this is where the skill comes in, and you have to take the whole picture here and see the symmetry of the base, the contractions. You're counting the contractions, right? You got your first pullback, 2, 3. So you got a 4T. I mean, it's perfect. It's super, super tight, coming right through a level here. If you go all the way across here, you see it's only traded above that level on few rare occasion here, and less as you're getting to the right side. So this supply is diminishing over time. So the overall picture here, I mean, this is a perfect base. I mean, you don't get much better than this. If you were to use a precedent, this should be a precedent that you should be, stamping on the wall and looking for stocks that set up like this, especially off of IPO setups. Let's see here. And again, you're going to need experience over time. You're going to get good at this, and you're not going to be right all the time. You're going to do this, and there's times where you'll think it's a good base and it'll come out and it'll fail. And there's times where you'll buy a crappy base and it'll work. It's only over time that you'll start to see what works more than not, and how well a particular situation you could manage the risk, and you can manage the risk reward relationship. All right, so 150, 151. What about the overhead supply, July, August? So that's talking about the same chart here. Like I just said, this is way back, and that's not a lot of overhead supply. It's only been there for a short period of time, and it's quite a ways back. It's months back. The further back the supply is, the better, and the closer you are to it is better, and the depth of the decline. So there's a number of things you have to manage, but you have to assess. But when you take a look and you draw that line right across, you see that it really hasn't traded above that level. So you're really clearing out a lot of price action when you come above there.
Yeah, I've always said that the longer that overhead supply, they either have been worn out or they've probably passed away. Or they've died.
I never heard you say that.
That's a little morbid, but the farther you go back, the less that overhead supply is going to mean much.
Yeah. So page 157, Dave had commented that wedging up is bad. Why is the stock wedging up considered a bad sign, but wedging down is okay? So again, if we take a look right here, real quick, I'm just going to comment and then I'll give you this, Dave. So you see here, this is actually coming down. See how it drifts down, right? That's fine. I mean, it looks like it's sideways. It is sideways, but it has a little drift there. That's perfect. That's the optimal situation that you want to see. Dave, why do you want to see that, that drifting down? I think you've mentioned it several times during the curriculum, but let's answer this again, because there's so many questions about this drifting on this right side, and particularly I think we have to point out that what you're talking about mainly is on the right side of the base and in the pivot.
Yeah, and you'll see it show up over and over again, that situation. And what it does is it brings the stock in. It gives sellers sell off a little bit, but not much, and it shouldn't be much. It just gives the stock a chance to kind of rest before it before it breaks out and goes. If it's going up at a different angle, if it's wedging up, then it's not giving that stock a chance to rest from the prior move. This had a 10% move from 40 to 44. And then it's natural to get a few people saying, well, I'm a swing trader, I'm going to take some profits, and then it drifts off. You get out the week, any last week holders, and then the stock can break out and go. I can see some spots back in October on this chart where the stock was actually wedging up. Right around the end of September, early October, mid-October, through the end of October on the Shopify chart, and it wasn't ready. It wasn't breaking out, and it actually broke down and had to spend some more time. So It's just, you'll see this occur over and over again, the drifting. But yeah, Mark, if you could, look in October, you'll see some wedging up where the stock goes from 40 up to, that there. And then there's another one from right next to it. Yes, right there. See that? That's not what you want to see before a stock breaks out. You don't want this drifting kind of up looking pattern. You want it to go sideways to down just slightly.
Yeah, not optimally. And I'm going to say something that is really a golden nugget, and really most of you will not probably fully get this. You may intellectually, but really it's going to take time before it really sinks in and you understand what it really means. This is all about going through that process of weeding out the supply, wringing out the towel. All right. And as the stock is tightening and the volume is coming in, that is giving you an indication that less and less stock is coming to market, right? This is really important to timing. And this is what Livermore called the line of least resistance, forming the line of least resistance. Why do we get these explosive moves coming out once the stock sets up and we get this VCP, and then all of a sudden, wham, the stock comes out and just takes off? Why does that happen? Well, because there's no supply. It's just the law of supply and demand. If you have a little bit of supply and a lot of demand, the price moves. It's that simple with anything. It's not just stocks. It's the law of supply and demand. So this is a way to determine that. Now, each time that you come back to a old high, you get a trap buy. Let me take this out of here, right, and show you. So let's just say you have trapped buyers on, get a little stamp here, on this side, right? And you have profit takers here. Now the stock, you have bottom fishers here. The stock comes back up here. Now you get these bottom fishers, right? These bottom fishers, where is my tool? Bottom fishers here at a profit, and these people here are at a break even. Now, when that stock starts coming back down, it starts drifting down, these people here start losing their break even. They just sat through a decline and it came back to even. They're like, oh no, not again. I got to get out of here. Right. And they get weeded out. These people here that had profits that ran up starts giving their profit back. And they're like, oh, no, I got to get out of here. I'm giving my profit back. I was up, 5.6 points. Now I'm only up 3 points. You see, so now as that happens, the larger the decline, the more pronounced that's going to be. So when you go through that first iteration, you're going to have more pullback. Well, now you weed that out. So now you go to the next iteration. There's less supply. And as you keep going through that same process happens over and over and over again until you're finally in this little tiny pullback. And that allows those last weak holders to get shaken out. Now, let me explain. We, as low risk traders, are weak holders. We're very weak holders. When you're using a stop that's 5 or 6 or 7%, you're a weak holder. A mutual fund is not using a stop at 5%. I can tell you right now. Those are strong holders. Those are people that are buying the stock. They're not going to sell it if it's down just a few percent. So here's the key. All right. I'm going to give you a $1 million sentence. You want to be the last weak holder. That's the goal. That's the goal. I basically have built my entire career and my entire wealth on that concept of being the last, of trying to determine being the very last weak holder and getting in that stock at the most perfect time where the supply has been weeded out. And I am now in there buying. I'm a weak holder, but I'm the last weak holder. And my weak hold is not going to get pressured. My stop is not going to get pressured, or at least half the time. I don't even care. If I'm knocked out of the stock, that's fine. As long as when I'm knocked out, when I'm not knocked out, I'm making more than when I get knocked out of the stock. That's the whole idea, is managing the risk reward relationship. But I'm trying to be the last weak holder. Again, for those of you who can really truly understand that and appreciate that, that's a multi-million-dollar concept. All right, let me move on. That was a bit of a tangent. Let's see, page 164. So time compression. Markets in recent years have faster paced corrections and reversals. How do we account for that? The correction earlier this year was steep, but relatively short-lived. People who waited for time compression or for stocks to consolidate would have lost out on a substantial portion of an up move, as many stocks experience a V-shaped recovery. Okay, so here's the thing. You're going to say, we're going to break all the rules and forget about the concept of supply, demand, and proper basing and going through those iterations of wringing out the supply because the market came off a V bottom. I understand what you're saying, and that may happen. You may have a situation where you come right off the lows and stocks rip up in a V-shaped fashion. Well, then guess what? I won't be in them at that time. I'll have to wait. I'll have to wait until, and here's a perfect example right here on page 165, which you did not talk about, but again, here is a perfect example of coming right up the right side. I'm not buying here. All right. I'm not going to break my rules because all of us, okay, so then do you have any rules? If we say, or we're going to buy sometimes off of V's and sometimes we're going to wait for a proper VCP setup. No, you're waiting for the VCP setup. Sometimes you'll get a V-shaped market and it might take 6 months or a year before you get a proliferation of correct setups. All right. And you'll have to wait. That's just not your time. All right. So you got to be patient. You have to be disciplined. You're not going to, Livermore said you can beat a horse race, but you can't beat the races. You can't be in the market all the time. There's going to be long periods of time where you're out doing your homework, waiting for the next wave of setups. And that might be during a V-shaped recovery where your stocks are just not meeting your criteria. It's someone else's turn. Like, can someone else have a turn? The value guys have to make money too. They're going to buy off the lows and they're going to buy stocks that you wouldn't touch. And they're going to be selling stocks sometimes when you're buying or even before you're buying because they're, in their estimation, they're overvalued. Again, there's more than one way to skin the cat. The key is for you to become an expert at your way and to be patient and wait for those parameters so you know what to expect under specific conditions and how to operate. If you start trying to, you're going to change and try to adapt to every little thing, I got news for you. You're never going to do well. You're never going to do well because you're going to be a jack of all trades and you're going to be crappy at a whole bunch of things and you're not going to be a master of any one. All right, let's move on here. 165. Oh, so what is November 3rd buyable? November 3rd. Okay, again, good eye right here. Yes, it is. Absolutely. That would be a low cheat. Now, again, like many times, you get the low cheat, it runs up a bit, it runs into that supply, draw the line, right over here. Look, see where the majority of price action is? It's right above this level. That's why it's stalling out and has to go through that iteration. You see again how it's going through another tightening here. That's another ring of the towel, but it's smaller, right? Just like I explained to you, you have trapped buyers, bottom fishers, right? Now the decline is going to be more. Now you got less trapped buyers and bottom fishers. It's going to be a little less, and it just gets tighter and tighter until finally the supplies come out of the stock, and now it can move freely. But yes, this is a buy point that you could be buying there. Yeah. Now many of these, just so you realize, the grand majority of these examples I was buying at this particular time that I'm showing you. So I'm buying right here. Now, did I see it here? I may not have, or I may have. I may have seen, I don't remember if I saw the stock here. I may not have been confident enough to buy the low cheat at that time. Maybe the market at the time, I wasn't being so kind to me. I don't know. But sometimes I'll see a whole bunch of low cheats and I'll trade them from here. But again, this is where I was buying. All right, let's clear that out. Let me move on here. I think, what time is it here? So what do we start at, 10:30? So we're at an hour and a half, and I got to tell you.
Okay, guys, let me jump in here. This is where we're going to take the only break for tonight. It will be about 5 minutes. Let's get back on track in 5 minutes for the remainder of this question and answer session, which will be about another hour and 10 minutes after we can take this 5-minute break. And let's just start that now. Do your 10 jumping jacks I like to do. Get that blood pumping. For some of you, it's late night. If it's early morning, even better, and get your day started off right. And obviously for most of America, it's our late afternoon, early evening. Should have no problems at all. 5 minutes, we'll return and conclude with the question and answer session.